Hello there. Today we're diving into one of the most underrated but super important tools in the bond market, the offer. What is it exactly? What types of offers are out there? And how can one missed notification cost you real money? We'll go over examples, break down common mistakes, and show how a single overlooked detail can turn your investment into a loss. Stick around till the end to learn how to use an offer wisely and avoid getting stuck with a zero coupon bond. Like the video and subscribe to support the channel. An offer on a bond is a pre-agreed option written into the bond's issue documents that allows for early redemption. On the specified date, you may or must sell the bond back to the issuer, depending on the type of offer. Usually it's at face value, though other terms can apply. This tool acts like insurance for investors. If the market turns shaky or conditions no longer favor you, you can exit early. This is especially helpful when interest rates go up and new bonds start paying better yields. Just keep in mind, not all bonds come with an offer. You can find the details like date and type in the bond's profile on the exchange, in the issue prospectus, or via financial services like investment platforms. It's critical to know if a bond has an offer before you buy. It could totally shift your whole strategy. Issuers don't include offers just to be nice. It's a strategic move to manage their debt. When interest rates drop, they can buy back older, high-interest bonds and issue cheaper ones. If they've got extra cash lying around, they can use it to reduce their debt. For them, it's a smart way to adjust to market conditions quickly without damaging their reputation. And for investors, it's a chance to get their money back and reallocate it into a better performing asset, especially if the current bond no longer meets your goals in terms of yield or security. So, if used right, an offer can be a win-win. But what kinds of offers are there? Join our Telegram channel for video and article updates. You'll find the link in the description or pinned comment. There are two main types of offers: put and call. The difference is who initiates the early redemption. A put offer is initiated by you, the investor. You have the right to sell the bond back to the issuer at face value on a specific date. It's a right, not an obligation. The issuer can't say no. They must redeem it. Put offers are handy when the issuer is planning to change the coupon rate after the offer date. Often, they lower it on purpose, sometimes to as little as 0.1% to push investors to sell. If you ignore this chance, you might end up holding a super low-yield bond for years. Call offers are the opposite. The issuer is in charge. On the set date, they can buy back the bond at face value, whether you like it or not. This is generally riskier for investors. Maybe you were planning to hold the bond to maturity and enjoy that juicy coupon, but the issuer calls it early. If you bought it above par, you're looking at a loss. Call offers are popular during periods of falling rates. Companies refinance on better terms. To make up for the risk, these bonds often offer a yield premium. But that extra yield doesn't always cover the loss from being called. Here's a real-world example. An investor buys a bond with a 10.9% coupon for $10.89. They plan to hold it until 2026 and expect a yield of 7.93%. But the contract includes a call date, May 4th, 2022. The issuer calls the bond at face value, $1,000. In half a year, the investor earns just two coupons totaling $108.7, but loses $89 on the price. Net yield, minus 3.29%. And that's before taxes and fees. This kind of thing happens all the time. That's why you should always calculate yield to the next offer date. To use an offer smartly, follow a few simple rules. First, track the dates. 2 weeks before the offer date, the issuer announces the new coupon. That's your cue to act. Second, submit your request ahead of time, at least 3 business days before the offer date, preferably a week. Third, set calendar reminders so you don't forget. Fourth, read the documents. The bond profile and prospectus have all the offer terms. And finally, always calculate your yield to the offer date, especially if it's a floating rate bond. These steps don't take much time, but they can save you a lot of money. Now, let's say you weren't paying attention and missed the offer. The issuer drops the coupon to 0.1%, trying to wipe out their debt. The bond loses liquidity, the market price drops. You're stuck holding an asset that's practically worthless. This isn't some theory. It actually happens. Especially in unstable markets, issuers use every trick to cut obligations. That's why staying alert matters. An offer isn't just a date, it's a decision point. Miss it, and you lose. A call offer can hurt too. You buy a high-yield bond, then boom, the issuer calls it early. If you paid more than par, you're locked into a loss. Finding a similar bond with the same yield and term, not easy, especially if rates have changed. That's why call bonds are best left to seasoned investors. Everyone else should think twice. The key is understanding how an offer impacts your financial outcome. So, where do you find offer info? We've got a new article up on our website. You'll find free content there on stocks, bonds, and ETFs, from beginner level to pro. Check it out and bookmark the site. You can find offer info in several places. The most official source is the bond's issue prospectus, but it's full of legal jargon. It's way easier to use the bond profile on the exchange website or platforms like Rustbonds and Cbonds. Many brokers also show upcoming offer dates in your account. Another trick? Check the bond's duration. If the bond matures in 5 years but the duration is only 11 months, that's a sign an offer's coming. These tools help you stay ahead and make smarter choices. A common mistake investors make is calculating yield to maturity while ignoring the offer. That's a problem, especially with floating rates where you only know the coupon up to the offer date. Yield to offer is the real deal, more accurate and honest. Imagine buying a bond for $980 with a 10% coupon and an offer in 1 year. Skip that detail, and your yield calculation's off. Only by focusing on the nearest offer date can you compare bonds properly and make smart choices. Ignoring this can lead to some serious disappointment. Submitting an offer request depends on the type. With a call offer, you don't have to do anything. The issuer handles it. But for a put offer, you've got work to do. First, figure out the request window. Usually 5 business days before the coupon period ends. Set a reminder at least 10 days before that so you can check the new coupon rate. Don't like it? Get your request ready. Ask your broker how to submit, what fees apply, and if it can be done online. Send your request at least 3 business days ahead, otherwise you might miss the window, and make sure you've got the right number of bonds in your account, or the broker will cancel the order. Once your request goes through, great. On the offer date, the bond is redeemed, you get your coupon, and the money hits your account. The fee is the same as a regular sale. Everything runs smoothly if you plan ahead. But if you miss the deadline or act too late, you might be stuck with a bond under bad terms. That's especially rough when there's a long time until maturity and a floating coupon. So yeah, participating in offers isn't just paperwork, it's a critical part of investing. Offers make bonds more flexible. They help you adapt to market shifts and lower risk. They're especially helpful in uncertain times, giving you a way to lock in gains or exit without losses. But they do require action. Track your dates, read the fine print, and do the math right. Yes, there may be fees and a bit of hassle, but that's nothing compared to protecting your capital. The most important thing is knowing how it works and using it wisely. Offers are powerful tools for managing bonds. They can be your shield or your trap. Always check for offers before buying. Figure out what kind, note the dates, run the yield calculations, and submit requests on time. If you get this right, your portfolio becomes stronger, more predictable, and more profitable. Give this video a thumbs up and subscribe. You can support the channel through our membership platform. Links in the description or pinned comment.